Welcome, future investors. Today, we dive into the exciting world of investing. Now, you might be wondering, why invest? Well, investing is a powerful tool that can help you grow your wealth and secure your financial future. It's like planting a seed today so that you can enjoy the fruits of your labor tomorrow. But where do you start? In this video, we will guide you through the basics of investing. We'll talk about setting financial goals, understanding risk and return, and exploring different asset classes. We'll also delve into types of investment accounts, basic investment strategies, how to research investments, and how to build and adjust your portfolio. Our aim is to provide you with a comprehensive yet easy-to-understand guide to kickstart your investment journey. So buckle up and get ready to embark on a journey to financial freedom. Before we start investing, we need to define our financial goals. Setting financial goals is like charting a course for a ship. It's about knowing where you're going and how you plan to get there. Without clear financial goals, we're essentially sailing without a compass. Financial goals can be categorized into three types: short-term, medium-term, and long-term. Short-term goals are those you hope to achieve within the next year or two. These could include saving for a vacation, paying off a small debt, or building an emergency fund. It's important to remember that for these goals you might want to prioritize safety over high returns, as you'll need the money soon. Medium-term goals, on the other hand, are goals you're aiming to achieve in the next 2 to 10 years. This could be saving for a down payment on a house, starting a business, or funding a child's education. For these goals, you could consider a mix of investments balancing both safety and growth. Long-term goals are those that are more than 10 years away. These usually involve retirement savings or building wealth for future generations. For long-term goals, you can afford to take more risk for higher potential returns, as you have more time to recover from any temporary market downturns. Now, let's talk about some common financial goals. Retirement is a major one. It's about ensuring you have enough money to maintain your lifestyle when you stop working. Buying a house, another common goal, is about creating a home and potentially an investment for the future. Funding education, whether it's your own or your children's, is about investing in knowledge and future earning potential. Whatever your financial goals may be, it's essential to make them specific, measurable, achievable, relevant, and time-bound, or SMART for short. For example, instead of saying, "I want to save for retirement," make it SMART by saying, "I want to save $1 million by the time I'm 65. Remember, a clear vision of your financial goals is the first step towards successful investing. Investing is all about balancing risk and return. This is a fundamental concept in the world of investing, but what exactly do we mean by risk and return? Risk, in the investment realm, refers to the potential for loss. It's the possibility that the actual return on an investment will be different from the expected return. This could mean you get less than you anticipated, or even lose your initial investment entirely. Return, on the other hand, is the gain or loss made on an investment. It's the money you make from your investment, typically expressed as a percentage of the amount you invested. The higher the potential return, the greater the risk. This is what we call the risk-return trade-off. Now you might be asking, but how much risk should I take? That's where the concept of risk tolerance comes into play. Risk tolerance is an individual's ability or willingness to endure losses in exchange for potential gains. It's influenced by factors like your financial situation, your investment goals, and your comfort level with uncertainty. Some people might be comfortable taking on a higher level of risk for the chance of higher returns. These are often referred to as aggressive investors. On the other hand, conservative investors prefer investments with lower risk, even if it means potentially lower returns. The key is to understand your own risk tolerance. It helps you choose investments that align with your comfort level and financial goals. Remember, there's no one-size-fits-all strategy here. What works for someone else might not work for you. But here's the thing to remember. Higher risk doesn't always mean higher returns. And lower risk doesn't always mean lower returns. It's all about finding the balance that works for you. So when you're considering an investment, think about your risk tolerance. Ask yourself how much risk you're comfortable taking on. And remember, every investment decision involves a degree of risk. The goal is to manage that risk, not eliminate it. As an investor, understanding your risk tolerance is key to making informed investment decisions. Now let's talk about the main asset classes: stocks, bonds, and cash equivalents. First off, stocks, also known as equities, represent ownership in a company. When you buy a company's stock, you become a part owner of that business. Stocks are often known for their high return potential, but with this potential comes higher risk. The value of a stock can fluctuate dramatically due to factors like the company's performance, market conditions, or broader economic trends. Next on the list are bonds. Bonds are essentially loans that investors make to entities like governments or corporations. When you buy a bond, you're lending your money to the issuer in exchange for periodic interest payments and the return of the principal amount at the end of the bond's term, also known as its maturity. Bonds are generally considered less risky than stocks, but this lower risk also means lower potential returns. And then, we have cash equivalents. These are the safest and most liquid, meaning easily convertible to cash, of the asset classes we're discussing. Cash equivalents include investments like money market funds and treasury bills. They offer lower returns compared to stocks and bonds, but they also present the least risk of loss. Now you might be thinking, why not just put all my money in the asset class with the highest potential returns? Well, that's where the concept of diversification comes in. Think of diversification as not putting all your eggs in one basket. By spreading your investments across different asset classes, you can manage the risks associated with each one. For instance, when stocks are performing poorly, bonds might be doing well, and vice versa. This inverse relationship can help to smooth out the ups and downs in your investment returns over time. Meanwhile, keeping a portion of your portfolio in cash equivalents can provide stability and quick access to funds when you need them. How much you should invest in each asset class depends on factors like your financial goals, risk tolerance, and investment horizon. If you're saving for a long-term goal like retirement and are comfortable with higher risk, you might invest a larger portion of your portfolio in stocks. If you're saving for a short-term goal or prefer to take on less risk, you might lean more towards bonds and cash equivalents. Remember, the goal of diversification is not necessarily to maximize returns, but rather to limit exposure to any single type of risk. Even within each asset class, it's a good idea to diversify. For instance, you might spread your stock investments across different sectors, geographical regions, and company sizes. Diversification across asset classes is a crucial strategy for managing risk. It's about finding a balance that suits your individual needs and circumstances. So, as you embark on your investing journey, consider how these different asset classes can help you build a well-rounded, diversified portfolio. Next, we'll look at the different types of investment accounts. Just as one size doesn't fit all in clothing, the same goes for investment accounts. Each type of account has its unique features, advantages, and restrictions, designed to cater to specific financial goals. Firstly, let's talk about individual brokerage accounts. These are your standard investment accounts where you can buy and sell a wide range of investments, from stocks and bonds to mutual funds and exchange-traded funds. There are no special tax advantages here, but there's also no limit to how much you can invest each year. Moving on, we have retirement accounts like the 401k and the individual retirement account, or IRA. These accounts offer significant tax advantages for long-term savers. With a 401k, your contributions are generally made with pre-tax dollars, which means you don't pay income tax on the money you put in until you withdraw it. On the flip side, with a Roth IRA, you pay taxes up front, but your withdrawals in retirement are typically tax-free. Next up are college savings accounts, such as the 529 plan. These accounts allow you to save for education expenses on a tax-advantaged basis. Your contributions grow tax-free, and withdrawals used for qualified education expenses are also tax-free. Remember though, each of these accounts comes with restrictions. For instance, retirement accounts often have penalties if you withdraw funds before a certain age, and 529 plans require the funds to be used for qualified education expenses. It's important to understand these differences and choose the type of account that aligns best with your financial goals. Perhaps you're saving for a down payment on a house, planning for retirement, or preparing for your child's education. The type of investment account you choose can play a significant role in how efficiently you reach these goals. Choosing the right type of investment account can significantly impact your financial growth. So, take the time to understand the options available to you and make informed decisions that will help you build a solid financial future. Now let's delve into some common investment strategies. These strategies are not one-size-fits-all, but rather, they are tools in your investment toolbox that you can utilize based on your personal financial goals and risk tolerance. First up, we have the buy and hold strategy. This is a passive investment strategy where you purchase investments with the intention of holding them for a long period of time, regardless of fluctuations in the market. The idea is that, over time, the market will provide a decent rate of return despite periods of decline or poor performance. This strategy is built on the belief that the market, in the long run, tends to move upwards. The pros of this strategy include its simplicity and the potential for long-term growth. However, the downside is that it requires patience and a high level of risk tolerance, as it involves weathering potentially significant market downturns. Next, let's talk about dollar-cost averaging. This strategy involves investing a fixed amount of money at regular intervals, regardless of the price of the investment. By doing so, you're buying more shares when prices are low and fewer when prices are high. Over time, this can result in paying a lower average cost per share. The pros of this strategy are that it mitigates the risk of investing a large amount in a single investment at the wrong time. It also encourages regular investing, which can be beneficial for long-term growth. The downside is that when the market is consistently rising, this strategy may result in a lower return compared to a lump sum investing. Finally, we have value investing, a strategy popularized by the legendary investor Warren Buffett. This strategy involves identifying and buying stocks that are undervalued compared to their intrinsic value. The idea here is to buy stocks at a discount and hold them until the market recognizes their true value. The pros of this strategy are the potential for high returns and the thrill of finding hidden gems. However, it requires a lot of research and analysis, and there's always the risk that the market may never fully recognize the stock's true value. All these strategies have their own pros and cons, and what works best for you will depend on your financial goals, risk tolerance, and the amount of time you can dedicate to investing. It's also worth noting that many successful investors use a combination of these strategies. Remember, investing is not about getting rich quick. It's about steadily building wealth over time. And while these strategies can guide your investment decisions, they can't eliminate the risks associated with investing. That's why it's important to diversify your portfolio and adjust your strategy as market conditions change. The right investment strategy combines your financial goals, risk tolerance, and market conditions. Before making any investment, it's crucial to do your research. As we delve into the world of investing, the importance of research cannot be overstated. It's like a lighthouse guiding us through the sometimes murky waters of financial markets. There are essentially two main methods to evaluate investments: fundamental analysis and technical analysis. Fundamental analysis involves examining the underlying factors that affect a company's actual business and its future prospects. This could include looking at a company's financial statements, industry position, and market competition. It's like being a detective, digging into the nitty-gritty of a company's operations to assess its worth. On the other hand, technical analysis is more about studying statistical trends gathered from trading activity, such as price movement and volume. It's like weather forecasting, trying to predict how the market will move based on historical data. Both methods have their strengths and can be useful tools in your research arsenal. So it's not about picking one over the other, but rather understanding how to use both to make informed investment decisions. Now, where can you find information about different investment options? Well, there are plenty of resources available today. For stocks and bonds, company websites, financial news outlets, and regulatory filings are great starting points. You can dig into a company's annual report or check out analyst ratings and reports. For mutual funds and exchange-traded funds, or ETFs, fund prospectuses are a goldmine of information. These documents provide details about the fund's investment strategy, holdings, and performance history. Websites of fund companies and financial news platforms also offer valuable insights. And let's not forget educational resources like financial dictionaries and investment tutorials that can help you understand complex financial terms and concepts. Remember, the goal of research is not just to pick investments, but also to understand them. Because the more you understand, the better equipped you are to navigate the investment journey. Investment success often comes down to thorough research and informed decision-making. So let's keep this lighthouse burning bright, guiding us towards our financial goals. Next, we'll discuss how to build a balanced investment portfolio. A balanced investment portfolio is like a well-prepared meal. You wouldn't want only one type of food on your plate, right? You need a mix of different ingredients to ensure a healthy diet. The same concept applies to your investments. Building a diversified investment portfolio involves spreading your investments across various asset classes such as stocks, bonds, and cash equivalents. This approach serves as a cushion against market volatility because when one asset class underperforms, another might be doing well. Constructing your portfolio begins with understanding your financial goals, risk tolerance, and investment timeline. If you're aiming for long-term growth and can stomach some ups and downs, you might lean more towards stocks. But if you're nearing retirement and want to preserve your wealth, bonds and cash equivalents could make up a larger portion of your portfolio. Now let's talk about asset allocation. This is the process of dividing your investments among different asset classes. It's not a one-size-fits-all strategy. Your asset allocation should reflect your unique financial situation and objectives. For instance, a 25-year-old saving for retirement might have a different asset allocation compared to a 55-year-old doing the same. Once you've decided on your asset allocation, it's crucial to stick to it. This is where periodic rebalancing comes into play. Picture this. You've decided to allocate 60% of your portfolio to stocks and 40% to bonds. But after a period of strong stock market performance, the value of your stocks now makes up 70% of your portfolio. To bring your portfolio back to its original balance, you'd sell some stocks and buy more bonds. Rebalancing isn't about chasing returns but maintaining your desired level of risk. It's a discipline that keeps your portfolio aligned with your investment strategy, regardless of what's happening in the markets. Remember, building a diversified portfolio doesn't guarantee profits or protect entirely against losses, but it does reduce the impact of any single investment's performance on your overall portfolio. A well-balanced portfolio aligns with your financial goals and risk tolerance. Investing doesn't end once you've built your portfolio. In fact, the journey is just beginning. The financial market is a dynamic entity, constantly shifting and evolving. It's crucial to keep a finger on its pulse, regularly monitoring your investments. Are they performing as expected? Are they aligning with your financial goals? If not, adjustments may be needed. This isn't about chasing every market trend, but rather about ensuring your investments remain balanced and in line with your goals and risk tolerance. It's about being responsive, not reactive. Staying informed about market trends and economic developments is key. Following financial news, subscribing to investment newsletters, and using tracking tools can be useful. Just remember, information is power, but only when used wisely. Don't shy away from seeking professional advice if needed. Investment strategies can be complex, and sometimes an expert perspective can truly make a difference. Remember, successful investing requires regular monitoring and adjustments. We've covered a lot today, so let's quickly recap. We started by understanding the importance of setting clear financial goals, both short-term and long-term. We then delved into the concept of risk, return, and the crucial role of risk tolerance in making investment decisions. We explored the main asset classes, namely stocks, bonds, and cash equivalents, each with its unique characteristics, risks, and potential returns. We also highlighted the importance of diversifying these assets for better risk management. We discussed the different types of investment accounts, their tax implications, and restrictions. We then moved on to basic investment strategies like buy and hold, dollar cost averaging, and value investing. We explored how to research investments using fundamental and technical analysis. Building a diversified portfolio based on individual goals, risk tolerance, and time horizon was our next stop. Finally, we emphasized the need to monitor investments regularly and adjust as needed. Now you're equipped with the essentials to start your investing journey. Remember, every journey starts with a single step, so take that step today.